Just to point out, the presentation is designed to be purely informative. Recent observations are predominantly on our Singapore stock market, and we are not providing investment advice in this, and we don't actually provide investment advice. So to kick off, and I'm going to try and talk as quickly as I can. Josh, cut in, please, and tell me to slow down if I am speaking too fast, but I am mindful of the time and want to cover as much as possible. So look, in the year to date, the benchmark Straits Times Index has generated a 7% price gain with reinvested dividends, boosting that total return to 10%. Our near 10-year annualized total return of the 30 component STI is currently 5%. Of all the regional and of all the global indices, the STI is mostly correlated to the FTSE ASEAN All Share Index, and that's represented by the green line on the top right. And that's built on solid economic foundations. It's built on the regional bundling that comes with institutional portfolio flows. And that means the STI and the FTSE ASEAN All Share Index share a 90% correlation in daily close prices over the last 3 years. Singapore stocks also make up 27% of the FTSE ASEAN All Share Index. That reinforces the correlation. Now, for trading opportunities within and beyond the STI benchmark, of the current 30 STI stocks, those that have a 10-year trading history, Mapletree Industrial Trust, Venture Corp, and Mapletree Logistics Trust, all outpaced the Dow Jones Industrial Average over the last 10 years. Keppel DC REIT did as well, but that was listed in 2014 as now part of the STI. Now, those stocks generated 16% annualized total returns, those three that have been listed for the 10 years, while the least performing of the STI stocks was Dairy Farm International with a 6% annualized decline in total return. More recently, there are 7 REITs that make up 14% of the STI, and there are 3 banks that make up 40% of the STI. Now, they have been very impacted by global trends this year, global trends in sector movements, and that has provided rotation opportunities for investors. For instance, banks were among the strongest sectors of the world in the first quarter of this year, and that was on the back of resilient investment activity across the globe and a generally steeper yield curve. That yield curve is shown in the lower left chart by that dotted blue line, and that supported banks that follow the model of borrowing short and lending long. Now, since the 8th of June, when the 10-year yields ended the New York session at a fresh 12-week low, the US yield curve has flattened from 138 basis points to 110 basis points. Now, that flatter yield curve on the back of the lower 10-year yields has coincided with rotation into global REITs, because REITs globally have a median yield of 4%. So there's 800 REITs listed across the world, of which 60% are listed in the US, and of the 800, they have a median yield of 4%. Now, that compared to the 1% 10-year interest rate, as the interest rate obviously falls on the 10-year yields, you see rotation into REITs, which we did. Now, that saw the REITs globally outpace the banks since the 8th of June right through to the present. So global bank indices, with that flattening of the yield curve since the 8th of June, are down 6%, and global REITs are up 1%. And that's extended to the STI, with the 7 REITs averaging 3% total return since the 8th of June, and the 3 banks, DBS, OCBC, and UOB, averaging a 2% decline in price. Now, the big moves of 2020 and 2021 also attracted a surge of retail investor flows into our stock market, and that's illustrated in the lower left chart, lower right chart. You can see that the retail flows, they tend to swing to net retail inflows amid market weakness and swing to net retail outflows amid market gains. For an example, Singapore's largest stock by market value, in addition to our most traded stock, is DBS Group Holdings. That stock saw close to $2 billion in net retail inflows for the first 3 quarters of 2020, with the volume-weighted average price of the stock over the 9 months at $21. Then, DBS Group Holdings saw net retail outflows of close to 2 billion Singapore dollars in the subsequent 3 quarters, from the 4th quarter of 2020 right through to the 2nd quarter of 2021, with the 9-month volume-weighted average price at $26.40. So the VWAP price amidst the 3/4 of a significant amount of net retail selling, was 26% higher than the 3/4 that saw the significant net retail buying. Hence, while the STI has provided these modest 5% returns over the 10 years, comparable with the growth of other asset classes and, of course, the regional index, retail investors have taken opportunities amid the week-to-week developments in economic growth, containing COVID across the globe, and the resulting sector trends and big moves. And this was further demonstrated, I guess, when you look at the two ETFs that track the STI. Close to 60% of the combined inflows of the two STI ETFs over the past 10 years came in the space of just 10 months. And those 10 months spanned March through to December 2020, when the VWAP of those two STI ETFs was $2.67, and currently they're trading at around $3.10. Okay, so the competitive edge of global banks is a key driver of the STI. As we mentioned before, the three banks make up 40% of the STI. And so far this year, the three banks have averaged 18% total returns, very closely in line with global banks, which are up 19% so far in the year to date. For the second quarter of the year, the three banks reported combined net interest income of 5.13 billion Sing dollars, which was up 1% from 5.08 billion in the first quarter of this year. For the trio, this was the highest quarter-on-quarter increase in combined net interest income since the third quarter of 2019. Now, the growth drivers for the trio, they include increased digitalization, the broadening of wealth management services, and a continued focus on the supply chains of growth markets. For the growth markets, DBS, OCBC, and UOB have increased their combined annual income that is segmented to Greater China from $2 billion in 2010 to more than $5 billion in 2020. UOB's Rest of Southeast Asia franchise also grew 7% last year on the back of strong growth in Indonesia and Malaysia. And DBS also highlighted this year the amalgamation of its LVB business in India and the securities joint venture in China will enhance its presence in both key markets. Should also note that DBS and OCBC have more net revenue reported to Greater China and more loan exposure to mainland China than UOB, which has seen some measured moves in the three stocks over the past 2 weeks. And as illustrated in the lower left chart, yep, I got that right, the lower left chart, the combined wealth management net fee and commission income for DBS, OCBC, and UOB has also almost tripled from 700 million in the first half of 2014 to 2 billion, very close to 2 billion in the first half of this year. So what's happening in our market beyond the big banks that drive the STI is that global growth is really driving sectors, and that's seeing mixed moves in the second half of this year. A key reason for the various indices and sectors consolidating on their first half gains has been clear signalling from the Fed Reserve that while tapering of asset purchases may begin before the end of 2021, the consideration of the Delta variant and its impact on the US labor market remains a priority ahead of interest rate hikes. And we'll get an update from that tonight when the decision comes out at 2 a.m. Thursday morning tonight, and the press conference at 2:30. As we see in this table, this is the 150 most traded stocks in Singapore, broken down by sector. And you can see the three banks, in addition to the 31 stocks that are part of those 150 most traded stocks, they perform positive returns in both the first half of this year and the second half of this year through to 14 Sep. And we also saw the technology sector also generate consistent back-to-back returns. As a group, these 150 stocks, they make up 75% of our total market cap of all stocks listed here. They make up 95% of our day-to-day turnover. So if you're ever, you see the big list of stocks that we've got here in Singapore, if you ever want to break down to the most traded, we can give you, Josh can give you anytime a list of 150 stocks that are amongst our most traded, okay? And this is their the summary of their results so far in the year to date. Now, for Singapore, our economy rebounded 7.7% in the first half of this year. The STI ranked among Asia's 3 strongest benchmarks. all our key sectors of the Singapore stock market, as you can see in the table, they were all in the green for the first half. And a number of stocks also reported bumper year-on-year earnings growth. But as you can see in the table, in the second half, we've started on a more mixed note, which has been a global development. Concerns of the continued growth of COVID-19 on decelerating sequential economic growth has weighed markets. And look, this has been reinforced by the fact that even though we are scheduled or on a trajectory for the world to deliver, 9 billion vaccine doses by the end of this year, we are still seeing 4 million global cases reported every week since the end of June. In terms of 4 million new cases every week. And furthermore, the 7-day rolling average of the daily new global confirmed COVID-19 cases, it has not been below that key 350,000 level since October 2020, despite the global vaccine progress. So that 7-day rolling average of daily new global confirmed cases has to break below maybe that resistance, if you will, of 350,000 cases, which we haven't done for a year. Now, these concerns since the end of June, they have seen global stocks generate a marginal decline over the past 11 weeks, while the Asia-Pacific stocks, which include the STI, have generated 2% declines. Since June, we've got mining, utilities, technology, healthcare products, and basic materials among the stronger industries of the global stock market. Segments such as lodging, food services, leisure, airlines, and transport have been among the lesser performing industries. And this has reflected increased focus over the past 11 to 12 weeks on companies or industrial or trade-related segments of the stock market that have been able to remain fully operational in the course of COVID-19 constraints, while also possibly seeing some increased demand for their products and services. And that you can see that reflected through those differing sector performances. As we see in this table that represents those 150 stocks, utilities, technology, and basic materials have also been among our more defensive sectors in the second half through to 14 Sep. And those industries within the consumer cyclical group have been among our least performing segments. So the strength of manufacturing in Singapore has also extended to the stock market. Manufacturing stocks in Singapore, they span multiple sectors. They span industrials, technology, consumer staples, healthcare, and materials and resources. And I guess to further give you that seed that that performance differential we're seeing at the moment, the outperformance of the industrial, the manufacturing, and the trade-focused stocks compared to the consumer, services, tourism-related stocks, it can be seen just by looking in the global REIT market itself as well. If you look at the median gain of the global industrial REITs since the end of June to last week, it was 5%. And that compared to a median 2% decline for Asia retail REITs and a median decline of 5% for global hospitality REITs. So in Singapore, the strongest performance of the industrial S-REIT sector, they've noted that while the economic climate is challenging, logistics sector continues to demonstrate resilience. Demand for industrial real estate has been underpinned by the manufacturing sector, and that's been attributable or on the back of the expansion of electronics, precision engineering, and chemical sectors. Now, I've just got to run through as quickly as I can the remaining slides. This is an example of some of these resilient businesses amid the COVID-19 constrained global growth. And the recent earnings reports have also provided investors with a lot of insights onto which companies have been able to remain fully operational during the constraints. On the theme of resilient global investment, real estate agency Propnex, it reported net profit in its first half grew over 100% year on year, as did APEC Realty. Trade has also been a key driver of global growth and stock market activity. China-based shipbuilder has been the STI's strongest stock this year, Yangtze Shipbuilding, and that has secured orders for 118 vessels at a contract value of more than $7 billion so far this year. Now, it's a seller's market in shipping, as you know, but with regard to the potential business and the operational impacts that have arisen from these supply chain disruptions and, of course, soaring freight costs, Franken Group, the semiconductor company, has, with its recent returns illustrated in the lower left, has noted back in April that it witnessed across-the-board price increases for its raw materials. However, certain contracts with customers do provide them with leeway to pass on those costs to customers if material prices rise above a threshold. On the demand for semiconductors, UMS noted in August that global chip demand accelerated at an unprecedented pace in the first half of this year. It's noted that in Industrial Association Semi has said that maintaining global sales of semiconductor manufacturing equipment maintained a forecast to surpass 100 billion in 2022. And that will be a new high after it jumped 34% last year, or this year, I should say. And importantly too, UMS has also noted in 2020 it had this focus last year on the efficient supply chain management, and subsequently noted in August that the group's key geographical markets all grew substantially in the second quarter of this year. Should also mention on the healthcare product front, two household names that are really providers of healthcare services are included here, predominantly because Rappel's Medical Group has actively supported the government in its COVID-19 vaccination and PCR swab test initiatives. And then you've got Q&M Dental involved there as well, and Tianjin Zhongxin Pharmaceutical has also had a strong first half, coinciding with basically TCM to be one of the first industries to receive state reform measures in China in 2021. Now, these are just a few examples of stocks that have outpaced the benchmark over the past 11 weeks based on these global themes of resilient investing, which has been seen in our property market here in Singapore, in addition to the global demand for electronics and increased demand for healthcare products on the back of COVID-19 developments. And Q&M had that testing laboratory as well, which is coincided with those returns in the first half, and also was a factor in their returns. And also, I've got to mention that these are not recommendations, but rather an opportunity to provide some more educative examples on the relevance and the span of our stocks. Quickly moving on to commodities. Gains in commodities this year have been obviously also largely driven by COVID-19-led constraints. Other drivers include industrial sectors recovering faster than consumer sectors, agricultural stockpiling, OPEC supply management, in addition to, importantly, the decline of the US dollar index, which provides the benchmark pricing for most global commodity markets and thus maintains a direct impact on the demand and the cost for US priced commodities. Now, US dollar index remains 4% below its end of its pre-COVID level of at the end of 2019, and the weakening of the US dollar, it generally increases profit for commodity explorers, while the strengthening of the US dollar can have the opposite effect. The price of crude oil, it's down, I look at it, down 5% from July highs. Copper is down around 12% from April highs. Iron ore prices have really been swinging, down 40% from July highs. And soybeans is down around 12%. CPO, crude palm oil, is off only 2%. So on the energy front, RH Petrogas noted in August, OPEC production increases do tie in with expectations of a demand-led recovery in the second half of this year, but at the same time contend with uncertainties that remain with the ongoing spread of COVID-19 on the Delta variants. And of course, must take into account there is a possibility of sudden interest rate hikes and an increase in supply from a resumption of Iranian oil exports. So that's what the OPEC production increases have been based on or tied in with. On the mining side, Fortress Minerals, it noted in July that it anticipates regional steel production will continue to grow in tandem with not just economic and population growth, but also policymakers signalling their commitment to infrastructure. On the agriculture side, Olam International reported strongest operational earnings since its inception back on the 13th of August, and the CEO attributed the group's strong results to a couple of key drivers, which include food security agenda, the rising food security agenda, the rising protein consumption, emerging market for, demand for food staples, and the industrial and fiber demand growth, and of course, rising technology adoption and the sustainability focus. And for the regional point, I should also add the CEO of First Resources noted in August that looking ahead, palm's attractive relative pricing against competing edible oils is expected to lend support to prices, while the lower export levy in Indonesia will help to reduce the export tax burden for exporters in the second half of this year. Okay, I should also note that Olam International now presently ranks just outside our top 50 stocks by turnover. That's following it was ranking as a 100 stock by turnover last year. And based on current market values, it's also then the biggest stock in our STI reserve list. Another quick slide. Among those 150 stocks that we've been focusing on, 15% or 22 of them have seen a more than 10-fold increase in daily turnover this year compared to last year. It includes 11 stocks listed on the main board, 11 stocks listed on Catalyst. The sector most represented by the 22 stocks include the industrial sector with 6 stocks, 4 stocks representing the consumer cyclicals, and then you have energy, basic materials, and real estate excluding REITs, each represented by 3 stocks. Now, while the 22 stocks of the table, they generated a median total return of 100% in the first half of this year, 105%, they have also generated a median decline of 12% in the second half to the 14th of September. And that comparatively higher return of the 22 stocks also saw higher risk. Important to point out that those 22 stocks generated a median 180-day historical volatility of 93%. Del Monte Pacific is the largest of the 22 stocks by market value. It reported a turnaround quarter for this quarter ending on the 31st of July, net profit of $18 million. The company also ended its previous FY on a turnaround year as well for turnaround net profit. I think it was $63 million US. They have been seeing their international market sales and their trade grow significantly. For the I think it was for the US. What was it? So the US is where they send the premium packaged pineapples, and they saw a 40% year-on-year increase for that. And then the S&W packaged products in Asia also grew significantly. Of the 11 Catalyst listed stocks, Grand Venture Technology is the largest, and it maintains maintains a strategy at the moment on an intention to transfer from the Catalyst board to the main board. And it also reported a 280% year-on-year surge in its first half net profit, while also declaring its maiden dividend. And that company is a homegrown manufacturing company that obviously services in life sciences and semiconductors and so forth. Catalyst listed OIO Holdings saw the greatest increase in trading turnover of the stocks, and the core business of that. Sorry, I've got a cat in here. Sorry, let me just pause for a minute, Josh. Can I get rid of the cat?
Sure, of course.
Sorry.
It's cute.
Thanks. Okay. The Catalyst listed I'll just give it a pat, and that'll make it happy. The Catalyst listed OIO Holdings, it saw the greatest increase in trading turnover. The core business units of OIO Holdings are blockchain technology services and mechanical and engineering services. So onto the final slide, drivers going into 2022. Obviously, vaccination rates remain important, but as does containing spread of the variants. And as we said, the 7-day rolling average of daily new global confirmed cases, it stands at around 600,000 cases. It needs to come down and break below that level of 350,000. We have seen recently, I guess, from the mid-August through to present, we have seen some of the momentum of the increasing cases through July through to mid-August come back and subside somewhat. But nonetheless, we've still got a long ways to go. For Singapore, our advanced estimates for the third quarter GDP will be released in the second week of October. And look, as we said, we grew 7.7% in the first half of this year. We're expected to grow 6 to 7% for the full year. So obviously expecting some slightly weaker numbers in the second half than the first half. But look, the services did not make a full rebound in the second quarter as well. So that will be watched closely, particularly because tourism is a really major contributor to the Singapore economy, and that has impacted shopping, accommodation, food and beverage, sightseeing and entertainment. But much like the globe, manufacturing has been a really strong aspect, a key driver of growth. And our PMI since June has continued to see expansion. It has for the electronics as well. And then, of course, for the region, we also have this big structural change. The total value of trade between China and its partners in developing Asia, it has soared in recent years by close to 50%, from 430 billion back in 2015 to something like 640 billion last year. And over those years, the 200 billion growth in trade between China and developing Asia has more than offset the 50 billion decline in trade to the United States. So this is structurally poising developing Asia as the larger of the two trading partners. And the value of trade between China and ASEAN partners has also grown significantly. So over recent years as well, these regional supply chains have been subjected as well to substantial restructuring. And that's been really influenced by the rise of the Asian consumer and developments driving trade growth such as technology, communication, and e-commerce. The key mega sectors that are typically associated with the driver of Asian growth, as the driver of Asian growth, and potentially over the next decade, partly due to onshore regulations and ultimate consumer focus, include finance-related services, business-related services, and information and communication services. Innovation has also played a role in China's growth and Singapore's growth. As we mentioned, we've seen significant patent growth here in Singapore. Yearly patent publications have grown sixfold in China between 2010 and the 2020 years. Over to the US, the next FOMC result is tonight, 2 a.m. Jackson Hole brought clear signaling that while tapering of asset purchases may begin before the end of the year, the consideration, as we said, of the Delta variant and the impact of it on the employment market remains the priority. I think the Minneapolis Fed president, one of the more dovish of the commentators, did mention it well, stating that while the US has made progress, its labour market is still in a deep hole, and that if COVID had not happened, there would be 7 to 9 million Americans working right now that are not working right now. So what we do expect is it has been reasonably quiet for the last 10 sessions overnight, and that's predominantly because of the blackout of the Fed speakers. The Fed Reserve members are speaking more and more and more, and the Fed chair has encouraged that in the name of good transparency, particularly when it comes to around tapering time. So what this means is you have a little bit more volatility, a little bit more focus on what Fed Reserve members can be saying that impacts the yield curve. And as you know, that very much, as we said in this presentation, very much impacts global banks, which of course impact the SDI. So the short-term rotations and the short-term trading opportunities are expected to continue in our market throughout to the end of the year. Okay, so that's it from me. We also have services that I can talk to you a little bit more about at any time. We basically, everything that we present, we also publish in reports. The report I write every Monday and collate with the team. It has something like 350,000 subscribers now. Anyone's welcome to subscribe to it. I dare say probably some of the audience tonight are already receiving that as well. And of course, we have our Telegram account. So more than welcome to find us there if we can help. But as I say, this is more about education, filling in some of the gaps, joining the dots, more so than some of the trading advice and so forth that the brokers such as Futu can provide. Okay?
All right. Thanks, Geoff.
Thank you.
All right. So I will just do a quick demonstration about Moomoo app, and we will jump to the Q&A session. So could you just start sharing this so I can?
Yep.
Yeah. All right. So apparently, so for this demonstration, it's only, I mean, it's not any trading advice. It's just to show you guys how to use the moomoo and the trade all this. All right. So here we go. So this is the moomoo app here, and of course, it's under the markets. You can see this SG. That is all the information you need for SGX. So the first one, of course, is about index. We do have STI, we do have all share index and the mid cap index. You can see the performance of each index of the day. Then because since Geoff mentioned that SGX, they do have a different instruments, we do have the entrance for rates. That is a rates you can trade in Singapore markets. Of course, this is you can rate by the price and also the volume. So apparently for now, all these big names, if you sort by volume, you can see all these Keppel, all these ESR, Ascendus, is all there. Then we have on top of this for SGX, we have other derivatives. We do have DLCs. And of course, for the DLCs, it's a derivative, so you can, for us, we are also running a zero commission promotion. Okay, so now you can see all these DLCs. That is all the derivatives you can see in the markets. Yeah, I think I got something wrong with the apps, so just want to show you here. We do have our rates here, so you can see all the rates, and if you sort by volume, you can see all these big names here. And we do have ETFs. So this subtype, you can see all the ETFs trading SGX. Yeah, same thing. If you sort by volume, then you can see all these. Let's see if you want to do some passive investments, do some, conservative. You are being conservative. You can just invest through the ETF, STI ETF, or other names. Yep. I think Geoff also mentioned that for ETFs, you can invest in other markets. So, for example, the recent very popular one is LGI OCBC. They track the Hang Seng Index. Yeah, so you can trade all these through SGX. The benefit, I mean, the good point is you don't need to do any currency conversion because you can settle in SGD. So it's something good to trade in SGX. And other informations like sectors. So we do, of course, we can see different sectors in SGX. So now maybe just for today, this retail defensive is doing pretty well. But since the Singapore government, they do have some initiatives, then hopefully we can see the technology or healthcare, yeah, all these sectors can outperform the markets. And yeah, then you can see all the main board shares. You can see all different shares here. Then you can do a screener as well, because for Singapore markets, you can set the filters as main board shares. Then you can set the filters. Then the system will tell you what is the most relevant shares fulfill your requirements. So yeah, then maybe we can just go one OKH. So because this is not investment advice, so just for demonstration purpose. Then for us, we can show you all these trading information here. This for you to, if you are more into technical analysis, you can see the charts. You can see 5 days, the performance in charts, and 1 day the candle chart. All these. Then of course you can apply some indicators, and you can see the bid and ask. Of course, based on the market or exchange data, we can just do this capital tracking. You can see what is the performance and also the track the cash flow from here. On top of this, we also provide more information about financials. So for those more into fundamental analysis, you can just see all the ratios and all the performance of each company. Then we do have a summary here. So for each companies, if you're not sure what they are doing, apparently for DBS or CBC Bank, most of people knows what they are doing here. But for the new companies, you can always check here. They will show you more information. Yeah, it's just a short one. Then we will back to the Q&A session. So I think during the, Geoff's sharing, we received some inquiries from our customers. So I think the first one is when you talk about Singapore markets, right? There are two different indexes. One is called STI index. The other one is MSCI Singapore. So
That's
what's
right.
the difference and what is the correlation between these two indexes?
I guess, two things. there's two major index providers across the world. It's almost a duopoly, if you will. FTSE Group, which have the FTSE indices, and then MSCI, which have the MSCI indices. Now, FTSE Group basically build those indices on the ICB classification of sectors, whilst the MSCI use the S&P GICS classification. So the indices, the sectors, they're kind of similar, but not 100% similar. So they are a little bit different. Okay. Now what we have is the SGI, which is basically the 30 most traded stocks here in Singapore, and the most how would you say, they are all listed here, and they are subject to the FTSE index inclusion. MSCI is a little bit different. MSCI can have Singapore stocks that are headquartered here, and it can also have what that means is that you don't have the Jardines in the MSCI index either, because if you're headquartered in Hong Kong, you're part of the MSCI Hong Kong. So CADR, the C depository receipt, is now part of the MSCI Singapore, and the C depository receipt is listed in New York. So that has a weight at the moment of around 10%. Okay.
I see.
So what it means is in the past they've been highly correlated, around 90%, very similar. Basically SGI would have 30 stocks, MSCI Singapore would have 25 of the same stocks without the Jardines, but now it's a little bit different because of the C and the Jardines not being part of it.
I see. Okay. Yeah, I think of course. So if you're talking about C and all these tech companies, they are in US. Then now US, you see the performance, but for the past 1 week, they're not doing well. So I think one of the audience asking how well this performance of the stock markets or in Hong Kong or in US affects SGX, the performance.
Well, it does. It does, because we have many sector drivers. It's just you just have to work out, though, do we have the same sort of stocks? Do we have the same sort of sectors? And how does it affect the index? So, I mean, if you look, okay, the biggest sector, the two of those biggest sectors we mentioned, the banks and the REITs, we have followed to a T almost the performances of global banks and Singapore banks. More so than APAC banks, we follow the global banks. And it's because we're all in the same boat at the moment across the world. We all face the same COVID-19 challenges, albeit it's getting a little bit less correlated now, because we are all emerging, obviously, touch wood, keep emerging in the right way. But like I said, the technology, the tech, when we had the Q&A before, those technology stocks, those 5 stocks with a 10-year trading history, they've all kind of been in line with the benchmark of the big global tech indices. So they're there, but will the audience necessarily know it? No, because it's a small part of the market. Those 6 highly traded tech stocks, they only make up 5% of the day-to-day turnover. They only make up 1% of the market cap. So what happens in our market, what happens in those indices are going to be really largely driven by the big stocks, the big banks, the Singtels, the like you said before, the Singapore Airlines, the Jardines, and so forth. So it's investors really in this Singapore market. We encourage them to do their homework, look beyond the benchmark, and look into the various segments and the industries that we've got. And that's the whole point of what I do at SGX. Hopefully, trying to make it a little bit easier and segment things up into these different industries, these different businesses and growth areas, and present, segment those stocks, provide that angling for the investors.
Of course. So I think one more question is about, kind of thing like if the risk is there, one thing you can do is to do a diversification. So from your strategist perspective, any advice to retail investors?
It's interesting, the retail investors in Singapore did it pretty well themselves. I don't want to give them any advice, in terms of last year. It's interesting in that I remember a year ago saying that, well, if the market falls, the year ago, the market was looking prime for a recovery, and it did happen. But if the market fell, we'd probably see more retail activity, because the retail investors in Singapore tend to be value orientated and like to buy amidst the weakness and sell amidst the highing. That's what we've seen in terms of the net retail inflows and outflows this year. For diversifying, yeah, there's a lot there. We have an incredibly diversified stock market, not just by the different sectors, but also where in the world these countries are operating. Particularly in our REIT market, the REIT market has morphed from a local, regional REIT hub into a global REIT hub. So, if you want access to data centers, if you want access to US office properties, you want access to Australia office properties, you want access, to China, Japan, Southeast Asia property market, the REITs are providing a lot of variety for investors at the moment. And that's yeah. Sorry,
Geoff.
Yep.
Yeah, that's a great advice to retail investors. So now I think time is about 7:50. So thank you for your time, Geoff, to share all these with us. And yeah, if you do have any inquiries, you can just feel free to drop us an email, give us a call. Yeah, we are more than willing to address and assist you further from here. All right.
Absolutely. Thank you so much. Thank you so much, Josh.
For the audience. Yeah.
Thank you.
Have a good day.